Good afternoon. My name is Amer Halawi. I'm the Head of Research at Al Ramz Capital, and I'm happy to be with you today. We've had exceptional circumstances and very low rates for a very long time. Then the fastest, steepest climb in interest rates in history. And now we're getting ready for a pivot where the Federal Reserve brings those interest rates down again. Obviously, interest rates are the equivalent of the price of money, and when the price of money comes down, then there are implications. The implications probably are that there's going to be further liquidity, and some of that liquidity is going to be channeled to the financial markets. There's going to be a granular move in the way of more volatility in the coming weeks and months, and we've been saying this as the market finds its footing from a historical high, and flows are going to flock to the most interest rate sensitive sectors and names. This is widely what we are expecting. Already the US market is performing really well. So geopolitics are very important. I think the most sound environment for investment is one of peace and prosperity. So anything that threatens peace and prosperity becomes a question to investors. Investors like certainty as opposed to questions and uncertainty. Of course, we would do better without geopolitical uncertainty, and we all look forward to an environment where such geopolitical tensions are removed and we can focus on the fundamentals. Some people will look at the very long term. Warren Buffett is a very long-term investor, famously known worldwide to invest forever in cash flow producing businesses. Other investors trade within the same month or within the same week, sometimes within the same day, sometimes within the same minute. And now we have machines with very high churn which trade thousands of positions every millisecond. So on average, the investment style will depend on your risk profile and your risk appetite. For us, in the fundamental research at Al Ramz, we look at moderate timelines, 6 to 12 months, to make our recommendations, and we keep an eye on the day-to-day gyrations of the market to assess the change in risk. So in a nutshell, I would say medium to long term with an eye on the short term. I believe that the impact is going to be global, and to the extent that we are a dollar economy and pegged to the US dollar, if the US dollar moves, then our markets should move along with it. Now, the Fed is essentially controlling the US dollar, or the actions of the Fed are having a direct impact on the US dollar. Now, lower dollar will probably be good for us, which means that lower rates will be good for the dollar, which will be good for us. How is that going to be good for us? Well, let's think of oil. Oil is denominated in dollar. Lower dollar makes oil cheaper. And so we expect that lower rates, significantly lower rates, will help oil prices remain where they are or push even higher. More generally, some sectors and some stocks are more sensitive to interest rates than others, even within a dollar-denominated economy. And the sectors that we'd be looking at today are perhaps defenses, utilities, largely indebted companies which might benefit from a cheaper cost of debt. On the other hand, some of the financials which might be negatively impacted by lower interest rates, such as banks, might see their margins crunching on the back of such decreases, could be less privileged than others. So in a nutshell, I would say utilities, growth businesses, and largely indebted companies should benefit, while I lump in energy as well, or commodities, while financials, including banks, could suffer. The economy here in the UAE, and particularly in Abu Dhabi, is doing extremely well. Companies are very well prepared, they are lean. And so an increase or a decrease, in interest rates will be a further validation of a good business model which is prosperous into the medium to long term. If, on the other hand, we get alarm or concern from the Federal Reserve that there is a slowdown in the United States and that a recession is knocking at the door, then this will be negative for everybody and it will be a sign of caution. But as we said previously, utilities, growth businesses, and leveraged businesses should be compelling to invest in, including those businesses with rich cash flow and high dividend yield. So we'd rather think in terms of sectors than individuals' names. As we've mentioned before, utilities, highly indebted businesses, defensive names in general would be compelling to buy, as well as the commodities complex. In Abu Dhabi, I think of the ADNOC ecosystem. This is related to a major commodity. If interest rates come down, this would be further support to the oil price as long as there's no recession. So this is a compelling segment in our opinion.